Well, here we go with chapter 2. In this chapter, we want to take a little bit of a review on some financial statement issues, and then we'll talk about calculating some possibly some taxes and some cash flow items. So the first thing we're going to talk about is the balance sheet. A balance sheet, as you probably remember, is just a picture of where a person is or a company is at any one point in time. The assets are on the left-hand side, and quite frankly, the assets reflect all the things that have been purchased for the company to use in the operations of business. Liabilities and owner equity on the right-hand side. Again, they are essentially just describing where the money came from in order to receive the assets or to buy the assets. So the left-hand side is all the things we've purchased, and the right-hand side really reflects just where the money came from to buy those things. The balance sheet identity or the accounting equation is assets equals liability plus stockholder equity. If we look at this picture again, it gives us this general clue. This is all the stuff that we've purchased, and this is where the money came from. The top two tiers of this, current assets and current liabilities, this reflects the short-term nature of running the company. The difference, current assets minus current liabilities, is what's referred to as net working capital. The bottom tier then obviously reflects the long-term nature of the company. So again, what are we talking about? Net working capital. It's usually positive for a healthy firm. If it's negative, essentially it means the company is cash starved. Liquidity talks about the ability to convert assets into cash without significant loss of value. Again, if we have challenges with liquidity, that might be an issue with respect to financial distress. We can't create enough cash to pay our bills and keep our creditors happy. So in the end, what do the shareholders own? Well, this is just the accounting equation, just do a little algebra. The owners of the company, the shareholders' equity equals its assets minus its liabilities. In other words, if you sold all the assets and you paid off all the liabilities, what would be left? That's the owner's piece of the pie, if you will. So here's a balance sheet. We can see this is U.S. corporation. Here are the current assets and the fixed assets. Remember, short-term, long-term. Over here on the right-hand side are the sources of financing, the short-term pieces and the long-term pieces. So we have in here this company from 2013 to 2014 has increased its asset base. That means it has increased the amount of assets it has to work with. Well, to represent that, they also had to show an increase in money. Where did this extra, I don't know the exact calculation here, roughly $400, where did this extra $400 come from? They had to get that money from somewhere. If you look at the top here, it went from 428 to 389, so we have less money in current liability, so that must have come from a long-term source. So there must have been somewhere along the line that we gathered those resources. And if you look here, retained earnings went from $13.20 to $16.29. It's up roughly $300. That's most of the increase. So we can find out, again, where the money came from and then how was it spent. A term that we'll frequently talk about throughout the course is the concepts of book value and market value. Book value is the balance sheet value of the accounts. If you remember, the accounting process records things in their historical cost basis. So that is the historical value of the assets on the company's books. The market value is the true value. It's the price at which the assets, liability, or equity can actually be bought or sold, right? The market value and the book value are often very different. Why? Well, because if management is doing their job, they should be making the company look better. They should be increasing opportunities, creating profits for the ownership. So which do you think of these numbers is more important to the decision-making process? The price at which things can be sold or the accounting value? And if you're an accountant, you probably think it's the book value, but the actual answer is market value is the more correct number. It's the number that provides us with better understandings, if you will, about the changes, the things that happen when we make decisions. What about looking at the market value? Again, here you can see the company, the current assets and net fixed assets. Here we go, was $1,100 to $1,600. The difference in market price over book, and that obviously translates over into the right-hand side of the balance sheet, where we see again there is an increase in value from the book value to the market value for this particular company. Next thing we want to talk about is the income statement, and this reflects performance over a period of time. So the net result is what we frequently refer to as the bottom line, is net income. So the question we have is, what does a company do with its profits? Who do the profits belong to? Profits always belong to the owners. So in this case, the net income belongs to the owners of the company. So what does the company do with these profits that belong to shareholders? Well, they can only do one of two things with it. They're either going to pay them to shareholders in the forms of dividends, or they're going to retain them. They're going to keep them and reinvest in the company, and we refer to that as retained earnings. And of course, an income statement equation is just the revenues of the company minus the expenses. So here's a very basic income statement for this U.S. corporation. We can see that it cost them $750 to create their product. They sold that product for $1,509. They borrowed some money, so there's some interest that's paid of $70. In the end, $412 was the profit that was made by this company. 103 of that was paid out to dividends to shareholders, which means the remainder was kept in the company and reinvested in the current assets, or in assets, the asset base. How statements are created is through a basic accounting system, if you will. We refer to it as GAAP, the General Accepted Accounting Principles. We try to match revenues. We want to recognize revenue when it's fully earned, and we want to match expenses required to generate that. What that creates for us, though, is some issues in the financial statements. It creates what are referred to as non-cash items. We're going to purchase assets and pay cash today. However, those assets are going to be used to generate revenue moving into the future. So we need to represent that cash or show that cash being used to create future revenues. And the line item we use for that is something called depreciation. We'll talk about that also a little bit later in future chapters. What about time and cost, right? There's fixed or variable costs. These typically are not lined up and easily seen on an income statement. Most of that information is internal information. It's very difficult to derive that from financial statements. There's one question that we typically talk about with respect to management, and that's whether they manage the statements themselves. That is, do they do anything to smooth earnings? That is, maybe when income is really good, they downplay the income, and then when income isn't so good, they upplay that so that it represents less volatile swings, if you will. So they want to try to keep investors happy with smoother types of earnings. Now, what's currently happening is we're moving to a more globalized accounting system. We're moving from GAAP to something called IFRS. It's the International Financial Reporting Standards. And when we move in that direction, then it's going to be much easier to make comparisons, especially internationally, between the companies that we're either watching for performance or we're watching for investment purposes. So that's part two. Or part one, excuse me. In part two, we're going to talk about calculating taxes and cash flows. So we'll see you in part two.